Welcome back. Well, joining us for our Farm Journal Insights this weekend, we have Dr. Justin Benavidez. He's the chief economist for USDA. A big week with USDA's Ag Outlook Forum. Dr. Benavidez, this is your first Ag Outlook Forum, but what is the biggest takeaway from your overall outlook on the ag economy, both for crops and livestock?
I think the big story for this year is that progress is being made. Obviously, we are not out of the woods in terms of cost of production, in terms of finding higher prices through new sources of demand, but we are making progress. We'll see cost of production moderate for the first time in several years. When adjusted for inflation, total cost of production will decline marginally, though certain producers are obviously going to see that nominal cost still go up marginally in the neighborhood of 1% on average. And we are still working very hard to, get out of what is really a 15-year discrepancy in that cost of production and price received for crops. And that's what we started talking about this morning. Is we've had some black swan events that have masked a long-term gap in cost of production and price received. And the way out of that is new sources of demand.
Yeah, so we've been talking about the headwinds just in the ag economy really over the last several years. You do see those headwinds easing this year?
That is what our forecast is saying. We have marginally increased prices for commodities on the year. So all of the corn, soy, and wheat complex forecast to have price increase by roughly a dime a bushel each. Marginal increase in price per pound for cotton, about 3 cents, from 60 up to 63 cents, and then marginally increased prices across the board for most of the other row crop commodities. Still some headwinds, obviously, like I said, cost of production not going down a substantial amount, but beginning to moderate, declining in real terms in some places. They're being outpaced by inflation for the first time in several years. So again, headwinds still in the forecast, but certainly beginning to make progress.
Yeah, at least that gives us a little hope. But let's look at the big acreage numbers, because you were projecting a 5 million acre decline in corn and an increase in soybeans, now at 85 million acres. But that decline in corn is about 1 million more than what the trade is forecasting. So what played into your acreage decision?
There's always discrepancy in forecasts, right? We're at very early season forecast numbers this year. A variety of factors are accounted for by the professionals at the World Board who live and breathe acreage and price on a daily basis. They're looking into factors, obviously the soy to corn price ratio, which is trending towards more bean acres relative to previous years. We're getting close back to that 10-year average of the ratio between soy and corn price, which trends towards a little bit more bean acreage this year when compared to corn. They obviously think about global stocks as well as domestic stocks and demand sources that can factor into total acreage choices based on what drives that ultimate price. And it really does boil down to where producers think that they will make the highest net return.
Well, when you look at combined acreage, we're also looking at lower principal acres than what most are expecting leading into spring. So is there regional discrepancies there, or do you just think farmers are going to plant fewer acres overall this year?
Our principal crops will see about a 1.5 million acre decline in terms of total acres planted, but the mix of other acres is going to moderate some of that acreage decline a little bit. But we do think some of that switch in and out in those marginal commodities and in regions that have a lot more flexibility in what they plant are going to change up the planting decisions this year. We saw a little bit of an increase in cotton forecast acreage that's going to account for some of those changes in acreage on the large end, which is going to also pressure price a little bit relative to where it could go. But there's just going to be a mix of results for the acres distributed across the country. It will vary across the country, but regional specifics, I think this is very early to be talking about regional specifics.
Yeah, we've been talking about some of those challenges, including in cotton and really in rice. So when you look out of all of the core crops, then which are you forecasting to face the most severe financial hurdles in 2026?
We do look at the cotton complex as something that is facing sustained headwinds. If you look at net cash farm income at the farm level, that number has jumped substantially for cotton, but some of that is a result of the robust policy investment that was made through the One Big Beautiful Bill. We're still facing significant headwinds from competition globally. A lot of increased production in Brazil that is competing with our exports from the United States. They have, in some cases, a lower cost of production than our producers here in the United States. That long-term trend towards more synthetic fiber and sort of a flat demand for cotton fibers is always a headwind the cotton industry is going to face. We do see some positive movement in price compared to last year, but the cotton complex is one that I certainly do think that I'll pay a lot of attention to this year.
Yeah, well, speaking of demand, looking at domestic demand for soybeans, the forecast projects a record-breaking 17.3 billion pounds of soybean oil used for biofuel. That's largely attributed to EPA's RVO proposal. But if that proposal were to be modified or delayed, how much of that domestic demand disappears, and what would that do to your current 1030 price projection for soybeans?
Yeah, our policy is to forecast with policy in place. So those are how we account for the projections, and changing one way or the other, answering whether it's going to have a huge impact on price or not would just be dependent on what those policy changes were. But that policy in place projection of 1030 is sort of where we wind up landing. If we begin to speculate too much, the forecasting can get a little out of control.
On the trade front, USDA did include China's commitment to buy 25 million metric tons of U.S. soy annually through 2028. So given that this volume is still roughly 14% below the 5-year average then, and considering the record crops coming out of Brazil, is the floor a sign of true trade recovery, or is it a defensive managed trade strategy to prevent further erosion of U.S. market share in the future then?
As an economist, we don't really focus on what the strategy is in terms of making those decisions, but in estimating what the total demand for soybeans will look like as a result of global demand, we look at that picture at the World Outlook Board in terms of what are global demands and global supplies. So if China or any other partner has demand for a certain amount of bean production, for a certain amount of bean imports, that's going to offset any readjustment in trade with other partners throughout the globe. So as far as whether or not the change would be as a result of an individual bilateral agreement, the World Board doesn't exactly take into account bilateral trade. We look at global demand on an annual basis, and we balance that with global supply and build a market picture based on those two factors.
Okay, that's good to know. All right, my last question for you, though. You mentioned the ag economy and your outlook overall, and it does sound like you think some of those headwinds will ease. But what do you view as the biggest wild cards for the direction of the ag economy this year? What are you watching?
I'm going to be watching closely to see what happens with the RFS debate as well as the 45Z rule. There is a rule coming out of USDA on flexible feedstock provisions that would augment the 45Z rule that came out of the Department of Treasury and provide those producers of feedstocks at the farm level with some incentive to increase the price of both beans, corn, and potentially canola under our 45Z rulemaking process. It provides a tax credit to refiners of those biofuels, and then that increases a derived demand for some of the biofuel input products, like I said, corn, beans, and canola. And then on the other side, thinking about what is the final outcome of the RFS debate? What does the RFS renegotiation or update that's happening on the Hill begin to look like? And that could really impact both the demand for corn and for beans, depending on where the RFS and that debate over E15 winds up going. Those are the two wild cards, particularly when you think about timing. If those changes and updates happen prior to planting, we could see a significant change in what the acreage forecast looks like, as well as what the price forecast looks like. And that could be distributed across the crop complex. We know that in some places where you might swap into planting soybeans, you're more favorable towards cotton. So we might see that if one of the policies on the biofuel side goes into place that favors soybeans a little bit more, we might see a reduction in cotton acres, or the opposite could be the case for corn, and a place that's a favorable planting area for sorghum or for rice or something along those lines. So I'm going to be watching closely to see what happens with the RFS debate and E15, as well as thinking very carefully about what happens if we get that 45Z tax credit rule pushed through and into place.
Well, I know it is a very busy week for you with the Ag Outlook Forum. I just thank you so much for joining us here on U.S. Farm Report.
And thank you all for the time. I really appreciate it.
Again, that's Dr. Justin Benavidez, Chief Economist for USDA. All right, we need to take a quick break, and then we are following the devastation in the plains, massive wildfires just impacting a large portion of the plains. What is fueling those fires this week? It's a check of weather next.